This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Welcome to another edition of NAIFA's Programs in a Box. My name's Keith Gillies. I am from Greater New Orleans. I'm a certified financial planner, and I have a boutique financial planning firm located just outside of the city of New Orleans. What I'm here today to talk to you about on this DVD is how we use annual review planning and year-end planning to enhance our relationships with our clients. So we'll get started. First of all, the standard disclosure information. This is all the reasons why you shouldn't do anything that I'm about ready to tell you. But we have the disclosure not only from my broker-dealer, but from NAIFA included here. Why do year-end planning? Well, we do it for many reasons, not the least of which is to help our clients minimize their taxes, review their estate plans, and prepare for the next year. Since this is being done in 2012, we'll talk a lot about 2012 and 2013, but the techniques will apply in any year that you're watching this. Another great reason is that you really do solidify your client relationships. I can't emphasize how important that is. And as you solidify those relationships, if you're having these annual meetings, you have documentation that you met with your client, that you reviewed all of these important points, and it will help you with compliance going forward. And finally, not the least of which is important, is the creating a great fourth quarter for you and your firm. It's an opportunity to see your best clients year in and year out, to have time to visit with them, and to talk about what's going on in their lives. So how did we come up with this year-end planning, annual review planning program? Well, you may remember in August of 2005, the Gulf Coast was visited first by the most powerful hurricane ever to be in the Gulf of Mexico, Hurricane Katrina, bearing down on one of the great cities of the country in the world, but a city that's below sea level, that being New Orleans. Well, we know what happened. New Orleans was underwater for several weeks, and it disrupted all the commerce for months to come. But what you may not know or remember is that Katrina hit the east coast of Louisiana. 3 weeks later, the most powerful hurricane ever to be in the Gulf of Mexico landed on the west coast of Louisiana. That was Hurricane Rita. Well, imagine all your business takes place from the Louisiana-Mississippi coast through Houston. And now all the roads are closed. There's no electricity. There's no internet service. There's no nothing. The city is shut down. The bridges are all out. How do you maintain your practice? Well, for me, I almost went nuts for a few weeks, but I was started to read articles after we cleaned out and rearranged our file cabinets for the third time, and one of those was doing annual review planning for clients. I was so intrigued by this that I got as many articles as I could about year-end planning and annual review planning. And as a result of that, I built a planning program. And over the years, after attending, watching seminars like this, attending other seminars and workshops sponsored by NAIFA and the MDRT, I came across some other information that I've incorporated in here. And I want to give special credit to a real good friend of mine from Mississippi, Jackson, Mississippi, Larry Fortenberry. Larry gave me a lot of information that we use as far as drilling down into tax forms. And I appreciate everything Larry has done for me. So that's just kind of an update of what happened. So how do you deal with this? What happens when your city is destroyed by some type of natural event? Well, the great philosopher Thomas Carlyle said this. He said, the block of granite that is an obstacle in the pathway of the weak becomes a stepping stone in the pathway of the strong. Now, I've used that to build not only from this disaster that happened in 2005, but to continue to build our practice since then. You know, in business school, they often teach you that you have to think outside of the box. Well, Sometimes the answer is actually inside of the box. And that's what we determined as we went through this exercise. At the end of 2005, we developed a complete planning program that dealt with annual planning. And what our plan was in January or February, whenever New Orleans opened back up and the Gulf South opened back up, that we were going to go around and give seminars on planning because people needed that. But I wanted to test it first. So here's what we did. We went out and sent letters. We sent letters to our top 72 clients. And we said, let's test this plan on them. Because we already had all of their business. There was nothing else to do. The year was shot. Let's go ahead and take these last 2 months, visit with our clients. If we can find them, let's visit with them and let's talk about planning. What I found was really fascinating. I found out that even with our A-list clients, our platinum clients, we didn't have all of their business. And there was a lot more planning that we should be doing and could be doing. Let me share with you these results. First, the letter we sent out was on October 31st, Halloween 2005. We sent out a letter. That letter is included in your packet, along with an organizer and a concern sheet. We sent out this letter to our top 72 clients. Over the course of the next 2 months, we had 123 meetings, almost all of those in our office. We had 15 unsolicited referrals, 12 of whom became clients. We did 44 transactions for $122,000 of first-year commissions. A year that was lost was saved by doing year-end planning. Now, if I would be like you, or many of you, this worked so well I would never do it again. But we've done it year in and year out, and I want to just share some other results with you. 2011, this was through October 31st of 2011. Again, only sending letters to our A-list clients, which now totals about 125. We had 32 meetings through October 31st, 2 unsolicited referrals, 40 transactions for $60,000 of first-year commissions. Let me share with you those results on this spreadsheet. We're going to highlight just the results that are roundtable credits. And what you will see there with these roundtable credits, that there's no $50,000 or $60,000 commission there. Most of these are small add-ons to existing planning that we've already done. In fact, I think the largest one on there is not even 5 figures. It may be about $8,500 of commission. So let me go over the preliminary process. I think you should send out the letter by October 1st. Remember, mine went out Halloween, October 31st. We still had those successes from the first year. Right now, we send it out about mid-September. Sample this with your top 10, 20, or 30 clients to begin with. See how it goes. Think about what's on the client's mind. Use the checklist that's included with this program. That's a 3-page checklist that will prompt you the questions to ask your clients. Think about using these year-end appointments at year's end, the last quarter of the year. Make the clients fill out the concern sheet. It takes a minute or 2 minutes to complete that document. And make sure you get the checklist. Also, if you have a small practice, maybe you need to set up the appointments, but as you grow, have your staff set up those appointments for you. In the letter, which is included with this package, on all of these things, get your compliance department to approve it, but use the letter and say in there whether or not the staff will be calling to follow up. And then you need to learn how to review the documents. So much of the rest of this presentation, I'm going to help train you into how to review the documents. What you see with this slide are 2 documents. The first document is an organizer and concern sheet. What we have with this is a checklist to prompt the client what to bring to our meeting. The second part of this document is their concerns. What are they concerned about this year? The other document you see there, and don't worry about it being 2007 or 09, they're basically all the same. These checklists are used in the interview with the client. Those interviews usually last about 30 minutes. We have their concern sheets, we have their documents, we have any updates that they have to their brokerage accounts, 401k plans, or whatever else is going on in their world, and we have this checklist which prompts the questions for you to ask. So, how do you conduct these meetings? Well, first thing is to review the checklist from the year before. Check your notes from the year before. Did you do the things that you said you were going to do? Did the client do the things that he or she or they said that they were going to do? Then you want to review the documents that the client brings in. Take a quick view of those documents while they're in your office, but then hold those for a follow-up meeting. Schedule a follow-up if necessary at that meeting. When you're sitting down with the client at that appropriate time, that's the appropriate time to set up the next meeting. Finally, and this is very important, you need to send an email summarizing the meeting. It's important for a couple of reasons. You're going to notify the client and remind them of the follow-up appointment. Number two, you're going to summarize all of the things that you've talked about and hit the important points. And number three, it's great for compliance purposes because you have a record of the meeting and the things that you've done. So what do you do after that? Well, first thing is you've got to review all of the notes from the meeting. Then you want to review all of the client documents. After you've done your review, follow up again with emails, prepare any proposals that you need to prepare, and keep in mind that the last business day of this year of 2012 is Monday, December 31st. If you're watching this beyond 2012, please make a note of what is the last business day because that's important as well. It's important for clients who are making year-end contributions to retirement plans and maybe 401k plans and other business, and maybe it's just personal for you for any type of goals that you've set for your personal production. Now, what about this analysis as you go through this? How do you go through this analysis? Well, first, we have payroll forms. So many of my colleagues disregard the value of the payroll form. There's a lot of gold in there. We'll talk about that. Tax returns. There's a lot of gold in tax returns for your review. What about client statements and documents? Lots of value and gold in there. And finally, their own personal checklist, because that's going to tell you what's important to them. So let's just start with the payroll and tax forms. This is a W-2 form. There are some very important boxes on this W-2 form. This one says 2006. It really doesn't matter. They haven't changed a whole lot, but they will be changing next year and the years to come due to the Obamacare legislation that was passed, because part of this document will now indicate how much the client is paying or how much the company is paying for their health insurance. So let's review this document, some of the important boxes on here. Number one, is there a difference between line 1 and line 3? That's income, which are wages, tips, and other compensation, and Social Security wages. Why is this important? Well, number one, it's going to tell us if they're contributing to some type of deferred compensation plan, usually a 403B, 457, or 401k plan. If you're dealing with state workers or teachers, there may be $0 in the Social Security box. That's going to tell you that the client or the client's spouse works for one of these entities. That's important as well because they usually have a nice nest egg of retirement benefits when they retire. You want to mark that up in your folders and in your file so that you know that's coming up. What type of retirement plan do they have? This is an opportunity to ask for those statements, the 403B statements, the 401k statements, and any other retirement plan statements they may have. Why is that important to you as an advisor? Well, let's think about this for a second. You look at their statement. They work for a nice-sized company, and they have 5 investment options in their 401k plan. Well, if you or anyone in your office or any of your colleagues do 401k plans, that's a great opportunity to go visit with the owner of that company and talk to them about their 401k plan and about the limitation they have on investment options. It's the same thing with a 403B. Maybe they have an annuity tied to that with a very long surrender charge. Maybe they have a great variable annuity or some type of annuity attached to that plan. Maybe they're very satisfied with their 403B plan. But these are opportunities for us to drill down and open up other opportunities for us and our firm. What about 12C? 12C talks about the taxable cost of group insurance. Maybe this is a big executive and that's a big number there. Maybe this is an opportunity to talk to the executive who may actually be one of the owners or the owner, or may be high enough in the food chain at the company to get you involved with the decision maker to talk about alternatives to having this high taxable group term insurance and having this money included on their W-2. What about these other 12 boxes, D, E, G, S, or Y? These illustrate elective deferrals that the client is making into those retirement plans. They will give you the exact amount of what they're contributing. Are they maxing out their 401k plan or 403b plan? Are they taking advantage of the catch-up provisions? These are opportunities for you to differentiate yourself from other people because they may not even know about these opportunities. Just a couple of weeks ago, we had a client, substantial income, not from their employment. Their employment only created about $55,000 a year of income, but they had $500,000 in other income. They were not maximizing their contributions to their retirement plan. They were putting $5,000 a year in, they could put in $22,000. So think of the joy when I told them that this year they have another $17,000 that they can put away for their retirement on a tax-favored basis. Very powerful boxes. In box 12AA talks about Roth contributions. Now, I don't know how you feel about Roth contributions. I have my own opinion, which I will share for a completely different time. But it's an opportunity now to review that to see if the client really should be contributing to a Roth 401k plan as opposed to taking the tax deductions today. So there's a lot of planning going on there. And you can see the time, and we went very quickly through this, the time and the information available just on a W-2 form. Think about what's on the rest of the tax return, how valuable that could be. We're going to jump to Schedule A. Schedule A tells me a lot of things about the client. The most important thing it tells me is their charitable intent. What are they contributing to charity? It tells me that if they're in a state like where I am in Louisiana, they're probably itemizing their deductions if they're one of our top clients. We have a lot of clients in Texas. There is no state income tax in Texas. So in Texas, they may or may not itemize their deductions, but they do have higher real estate taxes in Texas, so maybe that affects their itemized deductions as well. In your state, you will have to determine what's best for you. So what can we do there? There are a lot of issues with the Schedule A. You have to consider phasing out of the itemized deductions based on their income, but let's say that they can't itemize deductions and they will get a deduction for that. Then maybe we look at some of these techniques. Maybe they pay their mortgage 1 or 2 months earlier. What will that do? Well, that increases their interest deduction for that particular year. Maybe they want to defer that. So that's something that's important as well. What about paying their state taxes? And let's keep this in when we're considering 2012. Because what's very important here is what may happen at the end of this year with the expiration of the so-called Bush tax cuts. With that coming on board, do we want to, in 2012, do we want to delay deductions to 2013 where the tax rates may be even higher? So those are the considerations that we go through while doing these year-end planning reviews. And your client will appreciate your knowledge in these particular areas. What are some things that are not eligible for prepayment or really don't make any difference whether you prepay them or not, is if you're paying any rents or any other just flat-out interest on loans, because most of that's not deductible anyway, or prepaying any health insurance. That will not count as an itemized deductions. And what about investment advice? If you're giving investment advice to your clients, there's a 2% miscellaneous floor, deduction floor for that. So keep that in mind. And I can tell you what we do with some of our clients. If we have both IRAs that we manage for a fee and non-IRAs that we manage for a fee, we work out a deal with the client so that the fee comes out of the IRA, that it makes it all effectively tax deductible. And you can certainly do that. So you can see there's a lot of value there on the Schedule A. Now what about contributions to charities? Once again, I said this is the most important thing on here for me. Okay, how do they do that? Well, they can write a check to the charity. That's a direct contribution to the charity. Boom, they're good. They get a itemized deduction for the year. They can contribute to donor-advised funds if they so desire. They can contribute to foundations based upon their wealth, and you can look at charitable remainder trust. Now, ladies and gentlemen, this whole section could be a program in a box by itself. I just want to highlight a couple of these things that are really important. Number one, the gift of appreciated securities. If the tax law changes and we lose this nice capital gains tax we have today, in 2013, it could be an opportunity to talk to clients about giving appreciated securities or appreciated real estate to charities or charitable trusts. As you do those things, there's an opportunity to create what we call a wealth replacement trust. This is nothing more than an ILIT, an irrevocable life insurance trust, a grantor trust holding life insurance. So you make the contribution, let's say it's $500,000 of appreciated securities to the charity. The $500,000 goes into a trust. You get a tax deduction for the whole $500,000. You avoid the capital gains taxes, particularly in 2013, if they're 30% or more. You avoid that tax. You get a tax deduction. Then you can get an income from that trust for your lifetime, the client's lifetime, the lifetime of their spouse or the other beneficiary. You can use the tax deduction to seed the grantor trust. That funds the ILIT that replaces the asset that would go to the charity upon the death of the donors back to your beneficiaries, back to your client's beneficiaries, and under current law, it's all income and estate tax free. So it's a pretty powerful tool to use when we're talking about just charitable giving. So there's a lot of opportunities there, and we use charitable giving as a big part of our practice. One last thing here. When you see large amounts of charitable giving on a client's Schedule A, it's an opportunity to ask this question. Mr. and Mrs. Client, I see that you're giving substantial amounts to the St. Joan of Arc Catholic Church or the Lakeland Baptist Church. Who will make those contributions after you're gone? And how important is it for you that those contributions continue? And if they say it's very important and that no one will make those contributions, it's time to talk to them about using part of their current contribution to fund the cash value life insurance policy. The cash value is owned by the charity, so they can use it. Charities already have foundations set up or some type of accounts that they have for their charitable holdings. This is a place to hold that, and upon your death, upon the client's death, this insurance will flower and will fund their contributions for years and years to come. Very powerful information on Schedule A. What about Schedule B? What does this tell us? Lots of information here. Deferral strategies for the client, because Schedule B is about interest and dividends earned. So what are they earning on interest and dividends? And should we be deferring some of that? In today's world, there is an advantage to having qualified dividends. They're only taxed at a maximum rate of 15%. And also, clients who are CD buyers are sitting there now with CDs that are paying what kind of interest rate? I just looked at a newspaper yesterday, and I don't know when you're going to look at this DVD, but at some time today, April of 2012, the 5-year CD rates were running about 1.25%. Clients are struggling with that today. They're struggling with those low interest rates. And they have to pay full ordinary income tax on that. And we have inflation. So they're losing money each and every year. So what can we do? What, as financial advisors, what tools do we have to help them with that so they can get just a little bit more yield in their portfolio without taking any risk? Well, there's a whole array of annuities that will pay higher rates, in some cases much higher rates, than a 5-year CD today. Also, when we're looking at this Schedule B, we want clients to know that there could be year-end dividends. These dividends could be ordinary dividends, they could be qualified dividends, and they could be distributions that mutual funds make. If we all remember back to the great year of 2008, when clients' accounts were down 20, 30, and 40%, they were not very happy with their advisors when in January and February they started receiving their 1099 forms and found out that they had taxable gains on an account that lost 30%. Here is an opportunity for you during your year-end review session to not only explain this to the clients, but to document that you had that explanation with them. Schedule B, a very important document for us to review. Schedule D shows us our capital gains and losses for the year. What do we see here? We're going to see if there's a lot of trades taking place. If they have an account that has multiple Schedule D pages to it, or summary pages, then are their accounts being turned or churned? Is there something going on in there that we should know about? Is that something we should ask the client about? And I think so. Do they prefer mutual funds or do they prefer individual stocks? Depending on the size of their account, maybe they're better off with mutual funds as opposed to individual stocks. They could be good prospects for a variable annuity. Well, why is that? Particularly if the tax laws change and we lose some of this favorable tax treatment we have for capital gains, a variable annuity may be the way to go, particularly with those options, those variable annuities that have guaranteed living options with them. When was the last time the client reviewed or balanced their portfolio? Ask the question, when was the last time you rebalanced this portfolio? When was the last time this portfolio was compared against your risk profile? And the client may not have an answer. If the client doesn't have an answer as to when their advisor did this with them, you probably have a new account or a new client. Is there anyone overseeing the client's or the prospect's portfolio? These are things that are important not only in your annual review session, but anytime you get a new client and you're reviewing these tax returns, these are questions that you can be asking the client. Well, what do we do with Schedule D to help the clients? Well, number one, should we harvest some losses? Let's say they have some losses, and in 2012, they probably should not. The market has pretty much recovered. If they still have losses in their account, that's a good time to ask the question, why? Do we look at tax savings? Do we want to clean up the portfolio? Do we have things that they have too much of a concentration in one sector or another? Do we want to look at stock swaps? We can do stock swaps and maybe pick up some capital gains this year. Maybe we want to take capital gains out. We have a rule that says that that if you sell something, you cannot rebuy that security within 30 days in order to maintain the tax treatment of that sale. But we can go buy something in the same industry that may be a very similar company that keeps you pretty much where you were before. You may be able to get a little bit better performance. And also, when we're talking about reallocating these accounts, there's really two separate lenses to this. There is the asset allocation theory lens that says that we should rebalance these portfolios over a period of time, whether it's quarterly, semi-annually, or annually. That's up to you. It's a preference. And loss harvesting. Do we need to sell things just so we can harvest losses? And why do we want to do that? Well, for our clients, back at the end of 2008, we sold a lot of securities that had lost money that year. We swapped them for other securities. We built up a warehouse of losses that now, and maybe in 2013, if we want to take down those losses, we won't pay income tax on. If we want to take down gains, we won't pay income tax on those because we have a warehouse of losses for our clients. What about taxes? How do taxes fit into all of this? We've talked a lot about taxes, but what about just ordinary income taxes? And how does that fit into a client's portfolio? Do we need maybe a more tax-efficient portfolio? And what about Monte Carlo simulations? Simulating their portfolio, their contribution against what their goals are for retirement or other goals. So once again, Schedule D, very important schedule. Then we get to Schedule C. When I see a client with a Schedule C, particularly if it's their primary business, I do something like this. Oh my God, I have a brand new client. Because they should not normally be a Schedule C owner of a business, particularly if it's substantial. Why not? Well, under today's rules, they have unlimited exposure to payroll taxes, including Social Security and Medicare taxes. So we want to do something about that. Maybe set up an LLC that's taxed as an S corporation, maybe set up an S corporation, put them on a reasonable salary, and have the rest paid as some type of dividend or draw, and you can save your clients thousands and thousands of dollars each year in payroll taxes. But if they're stuck in a Schedule C and you're at the year's end, you want to reduce that income. You want to get that income down because of this unlimited exposure to the payroll tax. So what can you do there? Maybe they need equipment. If they're going to buy equipment in the next year, go ahead and buy it today. If they can't afford it today, or if they're waiting for a big check to come in January, put it on a credit card. It's still a purchase for the current tax year. What about furniture? Maybe they need furniture. Maybe they need equipment. Maybe they're in the lawn business and they need to buy a new tractor or a lawnmower. It's a good time to buy that in this year, this tax year, get as many deductions as we can for Schedule C, and then beginning in January of the next year, you would have, as a good advisor, changed their structure of business so that then they won't have these unlimited payroll taxes to look forward to. So when you come there and you get to a Schedule C, what do you do with these thousands of dollars that you're saving in taxes? Well, one thing they're going to do is if they cut the amount of money they're placing in Social Security, they should use those funds to help offset their loss of potential Social Security earnings way into the future. And we're not going to get into a discussion of Social Security, but I can tell you I would rather have my clients control those assets than to send it to Washington, D.C. We set up their accounts for them. Let's say they save $15,000 in payroll taxes. That's not unusual in these situations. Let's say we take $12,000 of that and we open for them a simple plan or a SEP plan or just an IRA for the client and his or her spouse. Now we get a tax deduction for that where before we had none. So that $12,000 may only cost us $8 or $9. We had $15 to deal with. We've spent in cash $8 or so. We're left with about $7. Let's take that other $7, buy them some life insurance, and buy them some disability income insurance. Now what you've done is you've enhanced their retirement plan. You've taken care of their family in the event of their premature death, much better than Social Security would have, and you still get a Social Security benefit. And number 3, what if they're prematurely disabled? Now they have a tax-free disability benefit that's much easier to collect than Social Security is to collect from a disability claim. These are all very positive things that you can do with the money that you've saved the client. And at the end of the day, how has it affected their cash flow? Absolutely zero. This is what separates the really good advisors from people who are just trying to sell products. Also, it's an opportunity to study that business owner's expenses to see if there's some things that you can do with them to help them cut those expenses or maybe use those in some other type of way. All right, what about Schedule E? What does Schedule E tells us? Schedule E tells us if they have rental real estates, it's a supplemental income and expense form, and we'll be able to look there and see if do they have a mortgage on the property? Do they not have a mortgage? If they have a mortgage, do we need to insure that mortgage? Or are they involved in a partnership? If they are, is there a buy-sell? So there's lots of things here that happen with the Schedule E, as you can see on this very next slide. If they have royalty income, what is the source of that royalty income? We have a lot of clients now across the country who have become very wealthy due to fracking. Fracking is a process where they go into lands that have a lot of shale, they fracture the shale, gas bubbles up, and the clients become multimillionaires when before they had a trailer on 10 acres of property. So there's some opportunities there to find out what is the source of that, and when you can find that cash flow, you can help these clients. What about the alternative minimum tax? Well, first of all, it is a horrible tax. It's affecting more and more taxpayers. And if something along the lines of the Buffett rule passes in the Senate, which I personally don't think it will, but if it does, that's another form of an alternative minimum tax. Unfortunately, if they're paying more than the alternative minimum tax, then they're paying more than maybe they should be paying in taxes. So how can we push the client's regular tax bill down to the alternative minimum tax? And is there a way to save them some money there? And it's very important to review that. We're basically finished with the review of the tax return documents, but I want to point out something very important. In fact, one of my friends we were just talking about this. The tax returns that are done by other advisors, most of those people, CPAs and bookkeepers and tax preparers, are not professional planners. They look at things retrospectively after they've already happened. Our opportunity is to look at things before they happen and really work in concert with those other advisors. That's an opportunity for you, when a client has a good advisor, to go sit down with that advisor and talk to them about what you do. I can tell you that almost all of my referrals are unsolicited from other advisors. And so I think that's very important as well as we go through this. What about some miscellaneous items? Well, as you go through the checklist, the items on there, one of those is 529 contributions. This is an important device, vehicle that we can use these days to help save for college for our clients' children and maybe their grandchildren. But there are some very specific rules associated with this, and you need to know those rules. So the 529 is not a panacea. It's not something that's perfect for everyone. You have to look at some other things that the client may want to do as far as saving for their children and grandchildren. And part of that is, particularly when you're talking about grandparents, is don't forget Steve Lineberg's Little Giant. And that's the $13,000 annual gift tax exclusion. This allows us to make gifts of $13,000 for every donee per donor. So if we have a grandmother and a grandfather, or a mom and a dad, and they have 3 children, that's $39,000 that goes from dad to the 3 children, $39,000 that goes from mom to the 3 children. Ladies and gentlemen, that's $78,000 a year. The Little Giant, it's a very powerful tool. You take that $78,000 a year, place it into a grantor trust. It protects the asset for the child, particularly for grandchildren later on. We're saving them from any losses due to bad business deals, because the trust will protect that. Any accidents they may have, or bad marriages, all the money can be protected. Now you just think about, what can you do with $78,000 of cash going into a grantor trust every year? Can you think of something that you could put into that trust that will help that money become even more valuable, a way to leverage that? We know the answer to that is you can use a life insurance policy to leverage those contributions. What about some other miscellaneous items? Well, it's an opportunity to help the client review their health care expenses. This is becoming a bigger and bigger burden upon retirees, and it brings us up to a whole new body of planning called retirement income planning, which when we get a chance at this meeting, I will talk about. What about their credit reviews? It's amazing how many clients never check their credit report. It's amazing how many clients do not know that they can get a free credit report from the 3 credit reporting agencies free each and every year. Where do you go for that? www.annualcreditreport.com. It's an opportunity. We advise our clients to do it each and every year, and you should do it as well. And I would be shocked if many of you in the audience are not even doing this on yourself, your own credit report. If you want a credit score, it's an additional fee, but you can get your complete credit report. It's an opportunity, if the client has issues on that credit report, to help them resolve those issues. Now, what about qualified plans? Well, we want to make sure that we get these done by year's end. And 401ks, SEPs, simple plans, and Keogh plans. 17,000 is the magic number in 2012 for 401k plans. Simple plans are a little bit less. SEPs can effectively be about 20% of the gross or the net profit of a Schedule C employer or an employee or an owner, and then they can contribute 25% of their salaries if they're S corporations or some other type of entity. There is a $5,500 catch-up provision on the 401k plans, and that is important because you can get clients putting away almost $2,000 a month in before-tax dollars in a K plan. What about some other issues? Required minimum distributions. Is your client 70 and a half or older? If they're in their 50s, ask them if they have parents who are 70 and a half or older. Here's an opportunity to talk about their parents' required minimum distributions. So often we run across clients who don't need those distributions, but they have to take them, and they're aggravated because they have to pay tax on them. There's a lot of planning opportunities here to use with IRAs. Maybe we have a chance, we'll come back to that. If they have a lot of IRAs, your clients do, is it an opportunity to consolidate those IRAs? Why do you want to do that? Well, it could have multiple fees associated with those IRAs. They could be $50 or $100 a year each. If they have 4, 5, 6, or 8 IRAs, that's several $100s a year. It's a good time to check all of those IRAs for the beneficiary designations to make sure that they qualify for a stretch IRA status. And finally, do you want to talk to the clients about converting some of that IRA to a Roth IRA? Once again, that's a discussion, that's a program in a box in and of itself. What about planning for 2012? Do they have any milestone birthdays this year? Are they 59 and a half? If so, it allows them in many plans to take an in-service distribution. So let's say they're in an inadequate 401k plan, but they might have $200,000, $300,000, $400,000, $500,000 in that plan, and they're 59 and a half. Check to see if you can do an in-service distribution. They can roll that money out of the K plan into a managed account that you have, or maybe into a variable annuity that has living benefits that will help the client. Great opportunities there. If they're 70 and a half, make sure that they're taking their required minimum distributions. Talk to them about their Social Security checks. If they're still working, maybe they want to delay taking Social Security until they're 70 and a half. What if they're retired and they don't want to delay Social Security? Should they take a check at 62? Well, I think a lot of factors go into that, not the least of which is what is their family history. If they have a family history where mom and dad are 90 and they're still alive and you're 62, maybe you delay taking Social Security because you may have, if you're in good health, a long life expectancy as well. And so if you delay 2, 3, 4, 5 years, your contributions become much bigger, and the net present value of that is a lot greater. So those are the things that you want to talk about with Social Security. And what about other retirement plans like IRAs? Well, you have to file the IRAs, have to be funded by April 15th of 2013. You must look, each year you do this. If you're in 2013 and you're reviewing this DVD, check to see what the last filing date is. Because, for example, in 2012, it was April 17th. The reason for that, April 15th was on a Sunday, and April 16th was Emancipation Day in D.C. It's a federal holiday for D.C., so we were delayed making contributions to April 17th. It's very important that you do that. It's an opportunity to review the strategies, goals, and objectives of the client when you're talking about these IRAs relative to their retirement plans or whatever their goals are. And finally, what about household budgets or spending plans? We don't like to tell clients they need to be on a budget, but they should have a spending plan. What are those spending patterns as they're rolling into retirement? Many people think they'll spend a lot less. In reality, they may travel more. They may do some other things which requires them to spend a lot more money than what they were expecting. What about the withdrawal rates? What is a reasonable withdrawal rate in today's world that has such a low yield? Are we looking at withdrawal rates of 5%? Should we drop those down to maybe 4% or even 3%? What about factoring in inflation? You know, we have an inflation rate that's published by the government, but it amazingly excludes food and energy, the two things that are running up in cost right now daily, and the two things that affect people who are retired much more than buying new houses, which they're probably not doing anymore. And finally, what about their health needs? We need to make sure that they have adequate health insurance coverage as they go into retirement. What about some other planning for 2013? If you have clients who have children who are in college or about to go to college, it's important to talk about this government form, this free financial aid for students form called the FAFSA. You have to do this early in the year. We recommend you get it done as early as possible. You want to get in line for scholarships and grants as early as possible. So very important to get it done as early as possible in the year. What other family dynamics are there involved? Do you have any weddings coming up? Have they had any weddings? Are they expecting any babies? It's an opportunity now for you to start building your referral list. And what about, unfortunately, divorces? divorces happen, it's an opportunity to talk to your clients. If they have children getting divorced, this is an opportunity to talk to them again about trust that protect their assets from these types of things that really do happen in the real world. So finally, we want to visualize April 15th, that magical date. This year was April 17th, but we're going to say April 15th. Visualize that. What are we looking for here? Are they paying higher taxes? What kind of income changes will they have? Will it be higher? Will they have underpayment of taxes penalties that we have to deal with? Will they confront the alternative minimum tax due to wage creep? What are ways that we can lower their income? How can we plan that, a planning shift for that? What about looking for additional deductions and planned contributions and credits for the client? What about a risk tolerance review? It's time to do that. What about a performance review? And what about reviewing our 2012 strategies and beyond? And keep in mind something. Each year, I have something here that's special and different. In 2005, it was keep in mind the Gulf Opportunity Zone. This was an opportunity for clients where we live to get big tax credits for 2005 and beyond. This year, I'm saying it's retirement income planning. This is a whole new body of work. It's very, very important, and it's something that we can help our clients with because so many advisors have always focused on the accumulation of assets and not the distribution of those assets. And it's a body of work that many of us are not prepared to do. So you should have some training in that and talk to clients as they roll into their retirement years. We need to talk to clients about retirement income planning. And that means you should go to the NAIFA website and try to learn as much as you can about retirement income distribution planning because there's lots of information there. And also the expiration of the Bush tax cuts. That could happen this year. If it does, we need to be prepared for that. Well, that pretty much completes the year-end planning, annual review planning part of the presentation, but we do have some time left, and I wanted to talk to you about something that is really important. That's retirement income planning. So we have a little bonus for you here. I'm sharing with you a presentation that I use with my clients and for potential clients, and we talk about retirement income planning because we're getting more and more referrals of people who are retiring. So let's talk about this. I'm going to start with the bottom part of this slide, which is to keep it simple. I could promise you that an 80-page colored graph report of retirement income planning is not going to help your client understand what they need to do for retirement income planning. Now, we need to do those reports because it's important to have backup information and backup data for compliance reasons. And you need to give that to the client. But I can tell you that retirement income planning can be done on one sheet of paper. It's really, really pretty simple. Because we have to look at the needs, the lifestyle, and the legacy, desires, and goals of our clients. So we have for that 3 boxes that we've created here. The first one is the needs box, the second one is the lifestyle box, and the third one is the legacy box. Now let me tell you what you do here. The only assets we're focused on are capital assets. Those are assets that create income. If they have a $10 million home and they don't plan on selling it, it is not an asset for purposes of retirement income planning. If they own property, they don't plan on selling that property or creates no income, it's not a capital asset as far as we're concerned. We're only talking about things that are capital assets. IRAs, rental properties, oil wells, gas wells, whatever they have, CDs, annuities, anything that creates income. Those are capital assets. On the other side of this sheet, we have sources of income. What sources do we have for us that we will use to solve that particular need? Now, this is hard to do on a camera, but let me see if I can get this through and we can make some sense of this. First thing we want to focus on and ask the client, how much do you need to pay your bills each month? This is something that they must have. They've got to have this money. And I don't care what the number is. It's irrelevant because if they don't have sources of income to pay for that, they can't retire. It's as simple as that. So if they want to retire and they have more expenses than they have income, they have a problem, maybe they should consider deferring retirement or they have to cut their expenses. So this is how much they need to have. This is to pay the light bill, the food bill, the insurance bill, all of the bills that are mandatory. This is not the money that they use to go to Europe every year. This is what they must have. Now, they usually have sources for this. Social Security, maybe some type of defined benefit plan, whatever that is. But let's just say that a client has a $5,000 a month need. They have $3,000 coming in from these other sources, so they're $2,000 short. Let's say that they have capital assets of $1 million. We need to guarantee that $2,000 a month. And what I think we need to do there is to use some type of annuity, whether it's an annuity with a GLWB that's going to create $2,000 a month of income, or a SPIA, or a combination thereof of these annuities and vehicles that we can use. And maybe you use a 5-year SPIA with a deferred annuity. There's all kinds of techniques there, but that money must be guaranteed. And for $2,000 a month is $24,000 a year. You're probably going to need $200,000 to $400,000 of that million, depending on what vehicles you use to guarantee that. So let's just take the top number or somewhere in between. Let's say we take $300,000. So we started with $1 million. We have $300,000 left. So on the left side, we scratch out the $1 million and we put $300,000 and we put it down to that box. $300,000 of your assets is going to the needs box because we need that money to pay your bills. Then you ask, what do you want to do from a lifestyle standpoint? What are the things that you want to do? This is about what the client wants and not what your 80-page report says. It's about what the client wants. So the client says, we want to take our children and grandchildren on a trip every year. How much do you think that's going to cost? Well, $15,000 a year. How long do you think you're going to do that? Well, we're 65 now, probably, until our health will not allow us to do that anymore. And I'll tell them that's probably, some people, we have clients in their 80s who could still make international trips. We have some clients in our 70s who can't. So let's just say it's 15 years. We'll take you out to 80 years old. So you need $15,000 a year for 15 years. That's $225,000. Now, you can check the math if you want, but I'm pretty sure that I'm right on that. So of our $700,000 that's left, we're going to take $225,000 and put it in a lifestyle box. That leaves us magically $475,000 left that they don't need for their needs or their lifestyle. This is legacy wealth, ladies and gentlemen. We put that $475,000 in the legacy wealth box. We want to use whatever, and there's all kinds of planning techniques. Maybe it's IRA money, maybe it's not. But imagine that $475,000 in that legacy box now. You've just explained to your client, you've taken care of, you've guaranteed the income for all of their needs, you've guaranteed the income for their lifestyle, you have $475,000 left. Let's say that's IRA money. What will that IRA average? It might average over a long period of time, let's just say 6% per year. So it's going to grow by 6% per year. What other issues do they have with that IRA that's left in there? Required minimum distributions. They're going to have to start taking money out of that. Why don't we go back to one of those grantor trusts we talked about before? One of those trusts where you could put money in it, and it's protected from the claims of creditors, it's protected from bad business deals, and it's protected from bad marriages. Let's create one of those grantor trusts, and let's use it for your grandchildren. So we're going to take this $475,000, we're going to create a grantor trust. You're going to have $25,000 a year of income spin off of this IRA each and every year. Let's fund that grantor trust, and if you're 65 years old, let's fund it with some secondary guarantee life insurance. And if we can, if both you and your spouse are insurable, maybe we do use a secondary guarantee. If they're one of you are not insurable, we may have to insure a single life. But let's put that money there. And I can tell you that on a single life, if you're in your mid-60s, you can probably get $2 to $3 million of life insurance and maybe $3 to $4 million of secondary guarantee. Now think about this. If we use that, we have created legacy wealth that goes well beyond the $25,000. We're talking about millions of dollars of wealth that you're creating for your grandchildren. Because you know what? You want your grandchildren to remember you. So here's what we have our clients do. They select a trustee. Each and every year, they will make a contribution, send a check to your grandchildren. But you know what? 20 years from now, they may forget. They say, oh, this was from a trust from grandma and grandpa. But that's all they remember about it. What we want you to do is we want you to write 25 notes to each one of your grandchildren. And then when they get that check, it's going to say something like little Andy or little John or little Diane or Diane, John and Andy. Here is a check from grandma and grandpa. We know we've been gone a long time, but we want you to know that we loved you very much and we hope you put this to good use, or whatever your words are. And when they get that check, they're going to get it from Grandma and Grandpa Jones. Let me tell you something. That's very powerful for your clients, and it's a very good tool for you to use as part of their retirement income planning. So we use this all of the time. It is 2012, and we do have the prospect, as I've mentioned before, of the Bush tax cuts expiring. We used this presentation in 2010 quite effectively with all of our clients. And we're going to give this to you today. So if it is beyond 2012 or if the tax issues are resolved, you can just turn off the DVD. But if they're not, or if this is something that we're facing year in and year out, I feel this is a great presentation that you can use with your clients to talk about year-end planning. So here's the deal. What if the Bush tax cuts expire? Here are some numbers that we put together, and it's a comparison of different income groups and what that means if the tax cuts expire. And we're looking at what their taxes would have been in 2010 or 2012. 2012 would have been a little bit less because of some inflation adjustments, but you'll get the point. And that's why we used the 2010 numbers. In 2010, if you had taxable income of $50,000 and you were a single taxpayer, your federal tax, adjusted gross income, taxable income of $50,000, you would have had a tax of $8,600. In 2013, if the Bush tax cuts expire, that number goes up to $9,500, an increase of about 10%, or $860. For someone earning $50,000 a year, that could be significant. If we look at someone earning $150,000 a year, their taxes would have been $35,000 and some change. Now they go up to $39,000. That's $4,000, ladies and gentlemen. Again, about a 10% increase in their tax. And finally, when we get up to the magical $250,000 number, we're looking at a tax increase of about $6,700. These are not insignificant numbers, and it may affect the plans that you have in place. What about a married couple? Let's look at those numbers. $50,000 couple, their taxes will go up again about a little over 10%, maybe about 12%, from $6,600 to $7,500. $150,000 couple from $30,000 to almost $35,000. So you're looking at almost a 15% increase. And for the $250,000 couple, you're looking at a $7,500 increase in taxes, or about 12%. These are significant numbers, and they are across the board. Very important for us to talk about our clients with this. What about our clients with taxable incomes of $1 million, high net worth clients? Well, in 2010, their tax would have been $320,000. That's taxable income. In 2013, it's $360,000. It's a $40,000 increase. We need to do two things. Number one, we need to prepare our clients for this potential $40,000 tax hit. And let's say we're lucky enough and we don't get this tax hit to our clients. We prepared them to pay the $40,000. Now in January, we tell them, you were going to pay this $40,000 in taxes. Let's do something else with it. Let's get it out of, since it was going to go to Washington, D.C. anyway, never to be seen again by you, let's take it and do something with it today that will benefit you, your children, or your grandchildren. So it's very important. Now, there are some other income tax considerations. Some of these have to do with the expiration of the Bush tax cuts. Some of these have to do with the imposition of Obamacare taxes. And let's talk about theirs. First of all, the dividend tax is going to go from a maximum of 15% to the client's marginal rate, 40%. Big, big deal. These are things, this is beyond the adjusted taxable income numbers that we just looked at. If you have clients who have substantial amount in bonds or in stocks, they're looking at a big tax increase. The increase of the capital gains tax to 20%. A continued creeping of the alternative minimum tax, which we spent a little bit of time on earlier. The Medicare Part A tax increases to 2.35% on joint incomes above $250,000. So you're looking at someone at $1 million, now paying 2.35%, another $23,000 in taxes just for the Medicare tax. A new unearned income tax of 3.8%. We're still waiting on regulations for this. What does it cover? Well, it's certainly going to cover royalty income, dividends, rental incomes, and stuff like that. Income like that, 3.8%. So you know that example I gave you earlier about the Schedule C income? Well, we're going to have to look at this. If that income is above $250,000, there may not be the benefits there were for that. A new Cadillac health tax plan. That will tax, particularly if we have clients and advisors in the Northeast or in places like California, they will have this Cadillac tax imposed upon them. There are many, many other direct and indirect taxes on drug makers, health plans, etc. So very important things that are coming down from that. What about the estate tax? We have such a great opportunity in 2012 to do substantial planning for our high net worth clients. Because in 2012, right now, this is the last year, unless the law changes, where you can give away $5 million of your estate and not pay any estate or gift taxes. Think about that. Think about the way you can leverage that. Let's look at what that means to your clients and why is it so important if you have clients who have net worths of 2, 3, 4 million or more to go back and talk to them about this. If the estate tax reverts back to $1 million, which is a pre-Bush tax cuts numbers, $1 million, in 2008 you would have paid zero tax, 2012 you'd pay a zero tax, 2013 you'd pay a zero tax. What about if it goes only to 1.5 million? Now you're talking about $210,000 in 2013. What about $2.5 million? Almost $700,000 of estate taxes. And what about $5 million? You're looking at a over $2 million estate tax. Ladies and gentlemen, it is malpractice if you're not talking to your clients about this today, to go back and talk to them about estate planning in 2012. You have an obligation. This is a reason for you to call them. It's very important. Take the slide, make a photo, print it out, get your compliance department to approve it, the numbers are right, and just mail that to your clients with the note, say, we need to talk. Get that out to them because it's very, very important. So those are things that are coming up. What about Roth conversions? We could spend a lot of time talking about Roth conversions. I think these are some questions that you need to ask. Do you want to need traditional IRA distributions? Do you believe your tax rates will be higher in the future? Do you have a desire to leave legacy wealth to your children or grandchildren, to your heirs? Will future governments change their collective minds about Roth IRAs? This is real important to me. What if you make a big Roth conversion today, and in the future, our government, believe it or not, decides to change its mind about taxation of Roth IRAs? And they say, you know, we told you that if you converted this and paid the taxes, we would never tax it again, but we were just kidding. So now we're going to tax that. And they will come up with something, some means testing. And if you don't think this can happen, think about Social Security. Right now, if you earn over $32,000 a year, your Social Security becomes taxable. So they will means test this. I don't mean they will means test Roth IRAs, but they have done it before, and they could possibly do it in the future. So think about that as you're doing this planning. If the tax brackets do not change for your clients, there's no advantage or disadvantage to keep them where they are. Beware of simple Roth conversion calculators. The world is not that simple. You have to really understand the mathematics of this, or you could be looking at a lawsuit 4, 5, 10 years into the future. And what about the impact that converting a Roth will have on other planning? What if you have children going to college? Now you've made this Roth conversion. You may have had an income of $100,000. You converted $100,000 of your Roth. You just blew away financial aid for your children by doing that. And what about other means-tested benefits? What about Social Security? So there's a lot of considerations that go into here, and it should not be, wow, let's take advantage of this Roth conversion because it's such a great deal. It may be a great deal, but it may not be a great deal. In conclusion with all of this, there's lots of planning that can be done. And we as advisors, we need to be out there talking to our clients about this because you know what? Other people are not doing it. Other advisors are not doing this kind of planning, or very few of them are. It's an opportunity for us. It's been a pleasure to share my thoughts and ideas with you, and I hope that you can use this to really, really enhance your practices. Thank you.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.